Hello, good morning. Welcome to my channel. Today is also live session, and today we will revise this working capital management and raising capital, cost of capital, finance risk and return, long-term financial management. And we also try to solve all these practice exam questions. And today will be the full day revision session. Let's start from the first question number. This one, financial risk and return. Okay, financial risk and return. We have to revise this one because this chapter is very much important. This chapter carries around 20% of total weightage, and this chapter we have to focus more, around 20%, and risk management, enterprise risk management, that will carry around 10%, and capital budgeting 10 to 15%. Some book you can find 10%, some book somewhere you can find 15% for capital budgeting. And this corporate finance is 20% weightage. So this topic is very much important for corporate finance. We have total 5 units, and out of 5 units we have to complete all. This one, financial analysis and corporate finance, total how many? 5, 6, 6 to 6. How many questions? Unit 1, financial risk and return, the 15 questions, and unit 2, long-term financial management, that there are 43 questions, and unit B, there are 2, cost of capital, and 3, raising capital, unit 4, working capital management, unit 5, corporate restructuring. Corporate restructuring is related to merger acquisitions and international finance. Total we have 6, but ideally there are 7, and there are 2 in unit 2, long-term financial management and cost of capital. And total questions, that is 6, 6, 16, 6, 34, 44, 44 plus 65, and 15, 80, and 43, 123, and 143. More than 100 questions are in this corporate finance only in total, and 100 questions, more than 100 questions this practical question, and another exam session question 100. There are 100 questions. Total 200, and essay questions, also essay questions are there. Essay question, there are question number 6, and we have not done any questions for essay type question. Total we have more than 200 questions, 6 essay question, 100 there is exam, that is MCQ practice test question, and over the we have the around 123 questions. And this one is unit 1. This is there are question number 15. Let's solve all these questions. Question number 1. Risk-free rate of interest, market risk premium, and beta coefficient are component of which following? Simple, right? This one simple is asking about components, which components related to the which component. It means we have the one formula, CAPM, capital asset pricing model. The formula will be there is calculation of market price, especially stock market price. There are two types of price. One, I have the stock, that is stocks. What is that stock market price, and another is a market price index, market price, right? That stock valuation, CAPM model. I need to value my stock. What is my stock price? In that case, we need market risk premium, beta coefficient, that interest rate, fixed interest rate, that's called also RF. And this is a simple formula of the CAPM. And this question's answer is this, just a CAPM. And question number 2. This question is very short, then we have to read all the question completely. ABC company has the following investment portfolio consisting of common stock of 3 companies. There are 3 companies. There is common stock. This common stock is also called equity, right? Equity share. Company Eble, Benning, Crown invested. Company ABC, so simple, you can remember ABC company invested 30% in A and 50% in B and 20% in C. Rate of return is 10% in investment A and 12% in invest, that is company B, and 18% in company C. What is the expected annual return from the investment portfolio? This is saying that what will the expected annual. Let's see, we need to just calculate the weighted average cost of capital, and weighted average cost of capital we have to calculate on the basis of the percentage. Investment A means 10% is the 30%, right? We have given 30%. It's come to the 3, and another 12% is the investment, 50% weightage, then 12% into 0.5. 12% into 0.5 is come to 6%, and 18% is the 20% weightage. Okay, that 18% having the 20%, and it's come to 3.6, and total, that is total come to 3 plus 6 plus 3.6, and it's come to 12.6%. 12.6%. This is the correct answer. And question number 3. This is a theoretical question, and this is not a large question. The difference between the required rate of return in given a risky investment and the riskless investment with the same expected return is what? It means one is risk-free investment, another one is risky and risk-free. Definitely, more risk, more return. Risk-free, less return. There will be the difference. What will be the that difference? What is that difference then? That's the different risk-free and risky investment different. Just we have to identify what is this. This is called beta coefficient? No. This is coefficient of variance? No. Standard deviation? No. This is risk-free and simple. Question number 4. A firm must select from among the several methods of financing arrangement when meeting its capital requirement. To acquire additional growth capital while attempting maximizing earning per share, a firm should normally is trying to maximize its EPS, earning per share, also called EPS and also called earning per share, both are same. And what plan the company should select, what method the company should select to maximize the EPS, but firm also need the finance, okay, also need money, finance to run the company, and but company wants to maximize EPS. Then how can the firm get finance? In this case, we have to think that EPS to be maximized, okay, and attempt to increase both debt and equity equal proportion. If we increase both equity and debt equal proportion, what will be the result? Because there will be no change, same ratio, and no change EPS will not be maximized. If we increase debt and if we keep same level, reduce equity shares, common shares, then EPS will be reduced. What will the EPS formula? EPS equal to net earning, that is for the shareholder, that is after tax whatever come, divided by number of total shares. It means denominated by number of share. If we reduce the number of share, then EPS will increase, one factor, okay. Another factor, if we increase the income and we keep the same number of share without increasing, then the EPS will also increase, right? In first option there is mentioned that both debt and equity proportion increase. This will not increase the EPS. Option B, discontinue dividend and use current cash flow. Means what? Dividend will be declared after calculating of EPS. Then there is no sense of discontinuing dividend. If we don't pay dividend, or if we pay dividend, there will not be impact on EPS. EPS will be calculated before declaring dividend to common equity shareholder. That is why option B is also not correct. Option C, select debt over equity. Initially, even though increased debt is accompanied by interest, cost, and degree of risk. What? See, if we introduce loan, borrowing, debt in the organization, definitely income will increase, turnover volume will increase, and net profit will increase, debt will increase. But we have not increased the number of share. We have keep constant number of share, and this is exactly matching whatever we are saying. Okay, because option first thing is we have not increased the number of equity share. We have increased the debt. If we introduce debt in company, and profit will definitely increase, and interest we have to pay, that's all. Debtors don't get any dividend, only interest, and number of share will not increase, and same, and income increase, number of share keep constant. In that case, income increase and number of share keep constant. It means EPS increase. This option is exactly matching. And option D is same. Equity select over the debt is increasing equity number of share. This will reduce only. That's why we have to go the option C is the correct answer. Question number 5. An investor has opportunity to either invest in money market fund that pay a compound daily rate of interest, or a 10 years treasury bond. If everything else being equal, the choice of money market fund would expose the investor to what? Option investor to risk, while investing in the T bond would expose the investor to risk. T bond is for 10 years. Okay, treasury bond for 10 years, and another one is daily interest rate. There is money market. This is short term. Treasury bond is long term. Treasury bond risks, I will tell you. Treasury bond especially risks increase if there is a duration increase. Treasury bond, because during the mid time without maturing, there may be the changes of interest rate for the bond. In that case, that bond issuer may buy back, and the bond may be pay back by the issuer. In that case, the investor may get the riskier on that treasury bond, and especially treasury bond consider if there is a long term period and more risky, and we have to consider a duration for the treasury bond. If there is a duration, especially time or duration both are same, and this T bond would expose to investors to that duration. Now question number 6. If Dexter Industries has a beta value of 1, then what is this? Beta is how much volatile that measures between one company's shares and market shares. How the one individual script that is a share will be volatile, divert from the market that measures by beta. And beta 1 is perfectly matching with the market volatility. It means stable with the market. That is, return should be equal to risk-free rate. It means risk-free rate means what? Market expected return should exceed approximate overall market. Means expected rate, this should not be risk-free rate. Risk-free rate, this do not measure between the risk-free rate and stock price. This measure between the market rate and stock rate. What is the volatility between market and stock? That measures by this beta. That is why return should be equal to risk-free rate. This is wrong. Volatility is low. Volatility is low. This is also correct, but not exactly answer. Price relatively stable. That is not correct. But 1 means equal to market rate. Suppose Nasdaq 100, there is around 17,000, 18,000 is running. Okay, suppose that increase by 10%. Suppose that increase by 2% today, and your stock price also increasing by 2%. And if Nasdaq 100, that is market, suppose that reduced by 2%, and your stock price also reduced by 2%, in that case this is called equal to market, approximately overall market volatility. In that case beta will be 1, and market price and stock price will be equal. Question number 7. Within a financial risk management context, the return value at risk is defined as the bar is there is a one what this is one, this is concept, and this is there is a diagram that will measure the volatility from -1 to +1. Between this range, the stock volatility will be there, and this normally measures what will be the maximum, what will the minimum for the certain period in given time frame, and that's also called that area is called confidence level. That's why maximum value of company can lose. This is first option is wrong. Option B, worst possible outcome given the distribution of outcome. This is also wrong, and option C is the correct answer. Question number 8. A firm has installed a new equipment to Indian value of their cost saving would be 15 million. At the end of the investment life, their actual return is only 10 million. This outcome demonstrates an example of what? A company has installed a new equipment, right? Install new equipment means investment. Company introduce fund in the business, and that fund utilized to purchase the equipment. That equipment will enhance the productivity in the organizations. That means simple, that is a investment, and investment in the business, and they were expected that 15 millions will be cost saving after installation of that new equipment, but unfortunately that actual saving comes to 10 million only. There is a 5 million is loss, and that this is what investment risks, business risks, political risks, market risks. What this is simple investment risks. Variance and standard deviations can be used to measure which of the following? Variance and standard deviation. Standard deviations is the measurement that is a square root of deviation is also called as standard deviation, and this standard deviation measure the deviation means how much difference, right, from one market price, how much deviated with the other stock price. This just to measure the deviation difference between the two things. That's called deviation. Also called variance is the square root of the deviation. Risks inflation interest revenue. This revenue inflation interest, no, this is just the risks. Question number 10. Investors are willing to accept a lower rate of return from the risk-free investments such as US government bond than they would accept from more risky investments such as share of public corporation. What is the difference between the investor required return and risk-free return? In this case, investors are willing to accept the risk-free rate of return. One risk-free rate of return will be lower, already we discussed, and if risky investment is there, then there is the high rate of return. The difference is on the risk premium, simple risk premium. The interest rate risks of a bond is what is this interest rate risks of the bond? Risks related to the possibility of a bankruptcy of the bond issuer. This bankruptcy of the bond issuer is not a risk rate of a bond, because if there is a risky investment, a risky bond, then interest rate price would be the high. That will cover interest rate high, will cover the risk of the bond, and this will not be the correct answer. And option B, risks related to the possibility of bankruptcy of the bond issuer and issue of the uncertainty of the bond. These are the same. This is also not correct. Option C, unsystematic risks used by factors unique in the bond. This unsystematic risk. This is also not correct. The risks arise from uncertainty about the bond return caused by the change in interest rate over the time. Normally bond are issued for 10 years, 15 years, 20 years, right? In this case, there may be the change of interest rate. If there is an interest rate is reduced, then the issuer may pay back that bond, and that will be the risky for the investor, and investor may reinvest in the lower rate. That will be the risk for the investor. That is the option D is the correct answer. Question number 12. Russell Inc. is evaluating 4 independent investment proposals. The expected return and standard deviation for each these proposal are presented below. That investment proposal 1, 2, 3, 4 expected return 16%, 14%, 20%, 22%. Standard deviation, how much deviation? Its standard deviation is 10%, 10%, 11%, and 15%. Which one of the following investment proposal has the least relatively level of risks? It's just we need to identify which one is the less risk. Just calculate, multiply by expected return and standard deviations. What will be the, which one will be the least? Means lower, simple. 0.1, and it's come to point standard deviation, expected return 16 multiply standard deviation 0.10 is come to 16 multiplied 0.1 is come to 1.6, and 14 multiplied by 0.1 1.4, and 20 multiplied by 0.11 this come to 2.2, 22 multiplied by 0.5 this will be the 3.3, and which is the lowest, and it's come to option second. Now question number 13. Using a cost of capital CAPM method, the required rate of return of a firm beta 1.25. It means this standard is more volatile than market. When market return is 14% and risk-free rate of return is 6%, we have the CAPM formula. CAPM is risk-free rate plus beta multiplied by market return minus risk-free return. Market return minus risk-free return will be 8. Market return 8, 14, risk-free return 6, and it's come to the 8 multiplied by beta equal to 10 plus risk-free rate is 6, and it's come to the 16%. And now question number 14. SK High Corporation has beta coefficient of 1.25, market rate 15%, expected risk-free rate 10%. What is the required rate of this? Is same as question number 13, and 100% matching the requirement as well. And market rate is 15, risk-free rate is 10 multiplied by beta is 1.15, 5 multiplied by 1.25 plus risk-free rate is 10 is come to the 16.25. This is the correct answer in question number 15. A company's year in selected financial data is shown below. Year 2 and year 1. Current asset year 2 equal to 250,000, and year 1 175,000, and total assets 600,000, and year 1 500,000, and net sales comes to 200,000 in year 2, and year 1 150,000, net income 75,000, and year 1 60,000. The company's rate of return on assets and the rate of return on equity year 2. Simple two formula we have to calculate. One is the rate of return on assets, rate of return on equity. This we have to think why there is a given 2 years. It means asset, while calculating asset we have to make the average asset 250,000 plus 175,000 is come to 4 divided by 2. Average will come to the 212.5 thousand is average asset, and year 2 212.5 thousand in average assets, and in year 2 income is 200,000 divided by 212.5 thousand, 212.5 thousand equals to 9.94. The return on assets, this is 600,000 and 500,000. The 600,000 plus 500,000 divided by 2 is equal to 550,000, and net income is 75,000 year 2 divided by 550,000 net assets, and it's come to the 13.63, and we don't have 13.63, and it's 14% only there, and also return on equity. There are equity total, how net current liability 600, 600 total asset minus current liability means 300 will be the equity, and 500 minus 275 plus 300 divided by 2, and it's come to the 287.5 thousand equity, and this return 75,287.5. 75 divided to 287.5 equals to 26, and this is 26% and 14%. This answer, option B, is the correct answer. We get 2 mistake here out of 15, and we have to check here what is the mistake there, and we have to check what is the incorrect. One incorrect happen, this one coefficient variance, standard deviation divided by expected rate of return. Coefficient variance, this formula we have applied wrongly, and another, all these are correct, this is also correct, this is also correct, and another, this too, this is wrong, and we can see here the answer also, all answer, this one is answer CAPM, and risk premium. This one, why this both reinvestment and price represent a form of interest rate risk, that is the risk of fluctuation in value of the asset as interest rate change. One component of interest rate risk is related to the inverse relationship between price and the yield of a fixed income security. The relationship is that if the required yield increase, then the market price of the security would decline, and the vice versa. Reinvestment risk is related to the fact that if one invested in short-term instrument, then interest rate decline, lower return will be available for the reinvestment if interest payment and maturing principal payment. Liquidity risk is defined as the risk associated with the possibility that particular investment Liquidity risk defined as the risk associated with the possibility that particular investment or asset cannot be sold in short run for its current market value. Default risk is the risk that the borrower will not able to repay their debt in timely manner. Purchasing power risk related to the possibility that a general increase in prices, inflation, will reduce the value of that can be purchased given amount of money. Duration matching is way that an investor can minimize the portfolio against interest rate risks. This one, investment coefficient variation, standard deviation by divided by expected SD by ER, coefficient variance. Now we have done corporate finance, that is question number 15. We have done question number 15, and we will do next for the